All right. Good afternoon, everyone, and welcome to today's Global Macro Trends Quarterly Update webinar, which will be presented by Dr. Lev Borodovsky, Chief Risk Officer here at Star Mountain Capital, and also the editor of the Wall Street Journal's The Daily Shot. My name is John Polis, and I will be your webinar host today. I am the Chief Operating and Technology Officer for your webinar sponsor, Star Mountain Capital. We are a specialized asset management firm focused on investing in large and underserved U.S. lower middle market of companies with typically under $15 million of EBITDA. Our differentiated business model includes a custom-built media and technology platform bringing proven large market resources to smaller businesses as a value-added lender and investment partner. Before I hand over the reins to Lev, I did want to let you know that your audio is muted and will be for the entirety of today's presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or webinar materials constitutes an offer to sell or a solicitation of an offer to purchase by Star Mountain Capital interest in any investment product. We have allocated time at the end of the presentation for Q&A. If you have a question, you can type it into the Q&A chat box of your WebEx client. We will try to get to as many questions as possible before our hour is up. Now about our presenter. Lev Borodovsky has over 20 years of experience covering private equity, risk management, and operations. He was a founding team member, chief risk officer, and managing director of the GSO Blackstone platform and one of the most successful global credit and loan investment platforms. Currently, Lev is the chief risk officer here at Star Mountain Capital, and he's also the editor of The Daily Shot, a chart-based newsletter covering select global economic and market trends that is now part of the Wall Street Journal. Lev, this is our third webinar together, and I guess we can call this a series, and we're really excited to get your thoughts today.
Sounds great. Thanks, John. Appreciate it. So why don't we get started? A lot to cover. The topic for today, I thought would be helpful to look at this year and what some people have called the year of rising risks. So what I thought we could do is go through some basic categories of risks that are out there. Just a note of caution, you know, I'm not here to provide a doomsday scenario. A lot of these are remote possibilities. But there's something worth watching. So we'll start with the list. We're going to look at first kind of U.S. political risks, then some of the geopolitical landscape, China, and then U.S. inflation and interest rates, asset valuations, and sentiment, and then a couple of slides on what the economists kind of expect to happen beyond 2018. All right, so let's start with this slide. And this comes to us from Davos. The Davos participants were asked to compare risks this year versus 2017, and overwhelmingly, they all said the risks are higher this year. And here's how they kind of categorize them. They looked at sort of political, economic, confrontation risks between states, military conflicts, regional conflicts, trade erosion, security alliances that are talking about the U.S. in particular, and to some extent the U.K., and the climate change, which is kind of an important but a longer-term risk. So that's what's coming out of Davos as far as the risk, and they're uniformly saying that they see risks rising this year. So let's look at U.S. political risks and what how can we categorize those? To begin with, from a political perspective, I now look at the United States as really two countries in one, divided by, extreme sort of differences in ideologies. If you look at the level of polarization in 2004, it existed, but there's a significant overlap between sort of the Republican Party and the Democrats. There's a huge overlap in 2004. If you look at 2017, the polarization is reaching sort of extreme levels, and it's a fairly toxic environment from that perspective that could pose some risks. So the first risk that I want to mention, we've seen the government shutdown, and there was a lot of hype about it. That was not a big deal. Government shutdowns typically don't do a whole lot to the stock market or the economy, other than potentially damage consumer sentiment. We may see some of that, a little bit of a pullback in consumer sentiment, which is at multi-year highs. The one risk that is coming up that nobody's really paying attention to is the debt ceiling concern. The debt ceiling is, if Congress basically doesn't act, the Treasury will run out of money sometime between March and April, some say, possibly even earlier. When they run out of money, this time it's not about government shutdown, it's about payments, right? And prioritizing payments. So the president will be required to prioritize payments. And what do? Do you default to government contractors? Do you default to Social Security recipients? Or do you default to Treasury holders on Treasury coupon? None of these things are pleasant and could be devastating. Again, this risk is remote. We've been here before and pushed this to the last minute, but ultimately this was increased. But again, given the polarization and the hostility and sort of toxic environment, toxic political environment, I would say that there is something to be concerned about and something to watch. So debt ceiling is coming up, and Congress needs to act. All right. So let's go to some other risks. There's a lot of hype in the media about this, but the Mueller investigation can pose risks this year as news comes out, and depending on what happens, could impact the government's ability to make, basically have policy decisions, or it could paralyze the government depending on the outcome. And somewhat related to this, there's an increasing chance that the House of Representatives will be controlled by the Democrats as of the end of the year. And, combine that with the Mueller investigation, again, creates for some potential political risks. This chart, by the way, shows the betting markets predicting effectively the chances of Democrats taking control of the House, and it's been in the kind of mid to upper 60% levels. Probably the most probable risks that we're already experiencing is the possibility of a trade war. Again, it's some of it is just hype, but it's something to pay attention to. So will the U.S. Basically entertain a real back and forth trade war with China? You know, some of this is already sort of starting to happen with the solar panels. You see South Korea is already seeking to retaliate by increasing their tariffs, and you know, just basically escalates. So you know, you impose one tariff, they retaliate. You impose another, they retaliate further, and it creates a kind of a vicious cycle. That is generally not a great thing for economic stability, and is not good for the market. Just as a quick overview, this map shows the biggest exporters, the exporting partners for each state, right? So you see the kind of northern states, the biggest export partner is Canada. Some of the the southwest, biggest export partner is Mexico. So these states are vulnerable to NAFTA. The Northwest is vulnerable to China. So there's significant risks as far as entering into you know, trade problems with these trading partners. NAFTA in particular is it's in the works now. They're trying to get that negotiated, but it could damage communities around the country. It could hit certain companies, and it's not, given the integrated supply chain that we have, it's not even exactly clear what the damage will be. You know, the auto industry will get hurt, but also the agriculture. You can already see with the lumber tariffs in place, you can already see lumber futures hitting new highs, and that's going to get reflected in the you know, new housing construction costs. So you know, everybody will feel that. Just sort of taking a bigger view, a broader view on this. If you look at what happened the last time the United States moved into kind of a protectionist policy regime, was in sort of 1929 and 1930. That didn't work out so well. Here are some of the actions that the federal government took in terms of tariffs and so on to restrict trade, and that turned out very ugly for the economy. And today we had another interesting risk which is related to trade. You know, we're returning to sort of currency wars. The Treasury Secretary Mnuchin basically is talking down the dollar, and this has not happened for decades. In decades we haven't had a U.S. Treasury official talking down the dollar. It's just highly unusual. And while he's right in that a weaker dollar is helpful for U.S. manufacturing exports, the concern that we have is what people call a competitive devaluation, where other economies, other countries will also push their currencies lower. For example, the Eurozone, where the euro has been strengthening, could decide to delay, the ECB could delay their exit from their quantitative easing to try to weaken the euro, right? And Japan could do something to weaken the yen, which has been strengthening lately. And so it creates this again, vicious cycle. Similar to kind of trade wars, this is another version of trade war, but done through via currency devaluations. So just something to look for if this escalates. switching to the geopolitical landscape, there's a lot going on there, and there are new risks are popping up all the time. You know, we certainly have the North Korea stuff that's constantly under the surface and bubbling up, and that's well covered. I mean, people are very well aware of the risks there, and I think some of these risks are already priced in. But it could escalate, and it could escalate in an unexpected way. Iran is another one. You know, strangely, I'm less worried about Iran. They have domestic issues that they're trying to resolve, which could spill over beyond Iran. But for now, I think there's going to be rhetoric, but I don't think it's that much of a threat to beyond what they've already been doing, which is getting involved in places like Syria and Lebanon. The one that few people talk about is Pakistan. I think Pakistan is moving closer in sort of hardcore Islamic way of running the government and law. So the level of tolerance is diminishing, and the anti-American sentiment is on the rise. In fact, if you were to poll Pakistanis and Iranians, my bet would be that as far as what percentage hates the United States, that percentage in Pakistan would be higher than Iran. Now you're talking about a nation that has nuclear weapons and other types of dangerous weapons, and is there's constant agitation on the border with India, which is another nuclear nation. So just something to watch. Turkey. Again, the media doesn't like to cover this much, particularly in the U.S., because who cares about Turkey? It's a NATO state, but Turkey's become an authoritarian regime and is increasingly belligerent and militant, you could have a flare-up. Even though the U.S. has a base there, it's pretty unpredictable how it will react. Whether it's Syria or even Greece, there's just a lot of hostilities out there. And then China. This is a very remote kind of risk, but the South China Sea remains a problem. The U.S. is probing that area. And the Chinese are getting agitated, and they're putting in more resources, assets in the islands, and I don't see a military conflict necessarily, but an escalation of tensions that could result in some serious market volatility is definitely possible. So since we're started with China, let's look at the economic aspects of China. What are the risks of China slowing down? It's really less of a concern these days than it has been since, for example, in 2015. But there are some headwinds in the Chinese economy. Their currency has strengthened, and part of the reason I believe they're strengthening the yuan is to appease the U.S., to make sure that the U.S. doesn't view them as a currency manipulator. By strengthening their currency, it removes some of that risk, but it also creates some headwinds for growth for them. The stronger currency has basically hurts their exporters, but also their interest rates have been rising, and credit expansion has slowed, which all of these things are resulting in a potential slowdown. This particular chart shows the official GDP growth in China versus a model from capital economics that uses various inputs to estimate what the GDP, the real GDP actually is. And it's starting to, the two are starting to diverge again, basically. So if you look at some of the capital markets in China, rates are rising, particular corporate bond yields have been climbing recently, and you know, one of the reasons I like to bring up corporate bonds in China is that they developed a whole market for something called wealth management products. I mean, when we think of wealth management products in the United States, we think of wealthy individuals and, you know, somebody managing their money. Wealth management products in China mean something entirely different. It basically means high-yielding deposit accounts. So you go to your bank and you give them some amount of money, lock it up for 3 months, and they kind of guarantee you, quote unquote, a high return, much higher than your typical sort of bank account would provide you. Now, the bank doesn't actually manage that money. They outsource that to a third party, which is generally some asset manager who a lot of times will buy corporate bonds or lend, provide loans to property developers and do things like that. It's a not only is this a high-risk sort of investment profile, but there's a massive asset liability mismatch, because these assets tend to be sort of 5 years, 3 years, 7 years in maturity, and whereas the liability of these products is, you know, 3 months. So in 3 months, if I want to pull my money out, I should be able to pull my money out. And as long as there are more people putting money in than the people taking money out, it's not a problem. But if you see kind of a panic withdrawal, these asset managers will be forced to sell, to liquidate, and create a bit of a run on the bank, effectively, in this space. Just something to watch for. Again, I think the Beijing has been pretty careful about trying to shrink some of these basically reduce the leverage in the system. And one way you can see them trying to reduce the leverage is in basically the broad money supply. The broad money supply is a representation of the amount of credit that's been created in the system. And you can see that the ratio of the broad money supply as a percent of the GDP seems to have peaked for now, which means that the leverage that's been increasing for years is starting to get curtailed. And the hope is that this will be a slow process rather than a big disruption, which could be dangerous. And one other thing in China, the economy is increasingly dependent on fiscal stimulus. This chart shows infrastructure as a percentage of fixed asset investment, right? So infrastructure tends to be a government funded or a state-owned, company-funded enterprise. So infrastructure increasingly dominates fixed asset investment, meaning that the private sector slows, the government has to come in and run big infrastructure projects, from railroads to bridges and other sort of infrastructure things to keep the economy going. if Beijing decides to pull back on this, again, we could see a slowdown more than expected. So that was China. I don't see China as a major risk. I think it's certainly there, but I wouldn't see it as a significant concern. It's just something to watch. Now, let's look at the back in the U.S. Look at inflation and interest rates. So we had this tax cut, which is definitely going to boost the economy, but it does, at least in theory, create an accelerating fiscal deficit. Basically a federal government deficit that is going to worsen dramatically. Now, obviously, this year is not going to be make or break it. So an extra trillion is not going to do a whole lot. But if people see that this trajectory of fiscal deficits is worsening more than expected, we could see some pressure on treasuries because people are going to become concerned about how much debt is out there and how much debt will be out there going forward. So just by the sheer fact that the Federal Reserve is now no longer buying treasuries and there's increased need for funding, the amount of treasuries issued this year will be significantly higher than we saw last year. And that those increases are expected to continue going forward. So a little bit of a kind of a fiscal pressure here going on. Now, on the inflation side, there's also concern in that, and if you just look at all the indicators out there are basically screaming inflation. Now, we've had this before, and inflation didn't materialize, so there's a lot of debate around this. But starting to get to the point where it's hard to imagine that we don't have a pop in inflation. It's just a matter of how big. I mean, if you look at the labor markets are really tightening in the U.S. And if immigration gets tightened further, we're gonna look. The labor markets could tighten as much as they have in Japan, for example, and that's problematic. At the same time, we'll have the dollar is getting hammered as we've seen today with the Treasury Secretary trashing the dollar. It's declining again, and so the combination of those and rising oil prices, and you're looking at potentially a pop in inflation this year. And you can kind of see that in inflation expectations in the market. So the 10-year break-even rate, which is derived inflation expectation from the Treasury-linked, from the inflation-linked Treasuries, is starting to rise. And also, you can see investors jumping into Treasury index, inflation index Treasuries. This chart on the right shows the shares outstanding of the largest TIPS ETF, which is the inflation Treasuries. So investors are starting to get concerned about this. So if we do get inflation, how high will the yields climb? And again, it's a there's a lot of debate about this, but nobody knows, right? You could see you can see sort of rates stabilize, but you could see them sort of the sell-off continuing throughout the year, which could get pretty ugly. So the chart on the left shows the 5-year treasuries, and some of that increase in the 5-year treasury yield is driven by the expectations of more aggressive Fed rate hikes, but some of it is driven by potentially near-term inflation as well. The chart on the right shows the probability of 4 rate hikes this year. And sort of in the fall, nobody thought that 2018 would have 4 rate hikes by the Fed. But as we move through, to the end of the year and this month, the market is starting to price in increasing probability that the Fed will hike 4 times. That happens. That's sort of beyond what people have expected and could shake other asset classes, other basically risk asset classes such as stocks. So that's just something I'm watching pretty closely. One of the developments in the United States that really stands out, and the media doesn't talk about it, in part because they don't understand it, is this contraction in financial conditions indices. So financial conditions are easy. And what I mean by financial conditions is it's basically it's an indication of how easy it is for, how ripe is the environment for to take risk. Is it an inviting environment for risk taking? And we're at levels where financial conditions have eased dramatically, despite the Fed raising rates 5 times. So if you look at the red line, that's the Fed funds rate, showing rates being hiked. And the idea is that financial conditions should tighten as rates increase. But that hasn't happened, that they ease. Part of the reason is the dollar. The dollar continues to weaken, and a weaker dollar eases financial conditions. But with financial conditions that easy, you're looking at asset bubbles and things of that nature that make the Fed pretty nervous beyond inflation, and so it could trigger the Fed to get more aggressive with rate hikes. So if you just look at this technical chart right here, shows the 10-year Treasury yield going back to the 80s, sort of been following this trend. And the question now is this over, right? And if we, from a technical perspective, if we break through this, resistance trend line, yields could go higher very quickly. One other note, this chart shows the this is a result of the Merrill Lynch Fund Manager Survey in January. And one of the questions they ask is, what do you see as the greatest tail risk, something that could just creep up very suddenly and cause a disruption in sort of risk assets. And if you look historically, it was things like China slowing down. If you look at 2015, it's all about China, right? In 2016, they were talking about the GOP winning the White House, and that concern, and that wasn't a big deal. But you know, they're talking about the EU and concerns about the EU stability and Brexit. But now the biggest thing on people's radar is inflation and potentially a bond crash. So this is where fund managers are concerned with. That's what they're concerned with, and that's what they're watching right now. So with the backgrounds, the trends that we described above, now let's take a look at asset valuations and sentiment. So, you know, people are constantly asking, is the stock market overvalued? And there's always debate about it. You talk to a lot of people, they say, you know, look, these earnings are accelerating, and the tax cuts created a boost for the stock market that just wasn't priced in before. And, you know, this rally will keep on going. But if you look at sort of some of the valuation metrics, they're starting to say that there's a little bit of a frothy situation developing here in the stock market. So this is Warren Buffett's favorite kind of macro measure, which is market capitalization as a percentage of the GDP. And that's up there. You know, this one is actually at the levels we haven't seen since the bubble of 2000. That's sort of the .com era. So just something to watch. Doesn't mean the market will crash tomorrow, but it's just you know, a useful data point. Another one is this thing called Shiller PE, which is also kind of an interesting metric that a lot of people track. And while we're not where we were before the .com crash, you know, the valuations still look pretty frothy. In fact, you know, on the basis of this metric, we're the stocks are valued more expensively than they have been before the 1929 crash. Another metric is this ratio. If you take the S&P 500 earnings yield, basically kind of projected earnings divided by the stock market value, you get a yield equivalent. And you take the ratio of the earnings yield to the 10-year Treasury yield, that number is starting to shrink. And as the 10-year Treasury yields rise, on a relative basis, the stock market becomes more and more overvalued. So even if the stock market doesn't rise anymore from this point on, but Treasury yields do, that basically is telling you the stock market is becoming more overvalued with higher interest rates. So another metric to watch. And then if you look at the sentiment, we're really at extreme levels. Just as an example, this particular metric takes the ratio of bulls to bears, and that ratio hasn't been this high since 1987. You know, right before the crash. So again, it doesn't tell us that, you know, we have a crash ahead of us, but it tells you that market participants are way too bullish, and that's you know, from the contrarian perspective, that's not a good place to be. And then, you know, on the credit side, spreads are kind of the tightest levels they've been in a decade. That doesn't mean much, because what credit people will argue is that default rates are extremely low, so it justifies very tight spreads. But default rates is one of these things that's pretty cyclical, and if we have a sudden slowdown, default rates could pick up rapidly. And basically, by looking at this, you say we're not getting paid for the risk we're taking. This particular spread is for high yield bonds. Here's one for investment grade bonds. Also, the sort of tightest level in a long time. So those are some of the things to kind of watch and things I'm tracking. Now let's take a quick look at what to expect beyond this year and where the risks are. So let's assume that this expansion lasts for another couple of years, which is what most economists are assuming, that we're really heading the end to the economic cycle will be in 2020. When that happens, you will have been the longest economic expansion on record. Now, it's been a slow expansion on a relative basis, but it will be the longest, which basically tells us that it's unlikely to last that much longer. Expansions are, at some point, they run out of steam. That's just the nature of the economic cycle. So 2020 is where the consensus is for a slowdown. Now, we're not going to see anything similar to what we saw in the last recession. The fundamentals are far better. The banking industry is in great shape. Globally, just general economic trends are decent. So if we have a slowdown, it will be a slowdown, a mild recession at most, but it will come. It's just a matter of exactly when. So that's kind of where we are as far as the cycle, and this is one of the projections of what employment growth would look like, for example, when we hit that slowdown. We're not going to lose a lot of jobs, but employment growth will slow. In fact, some argue that it's already peaked, meaning that the rate of hiring is already at as high as it's going to be, for the next few years, in part because the labor force isn't growing, and there's not enough people to hire. So that's part of the reason for the slowdown. But once you have an economic pullback, hiring will slow even further. And that's people are talking about, again, 2020. And some economists are saying that the Fed is going to be pretty aggressive this year and next year. And then in 2020, when the slowdown takes place, it may have overshot, may have gone too far, and will be forced to actually cut rates in a couple of years. And so one of the reasons actually that people suggest that the Fed should continue hiking aggressively is that when the slowdown does take place, there's going to be room to cut. Otherwise, at these really low rates, there's not much room before you hit zero. So that's there's quite a bit of debate about it, but you're talking about again 2020 we're hitting a soft patch in the economy. So that's kind of that's where the risks are, and obviously the soft patch in the economy means a correction in the stock market, widening yield spreads for credit, and in other risk assets correcting potentially. So so we're not there yet, but that's what people are talking about a couple of years from now. So that's all we have, and maybe we can basically have a few questions and some discussion.
Great, Lev. Thanks very much. Hopefully everybody out there was able to hear everything okay. We did have some technical problems at the start of the webinar, but I think we've overcome that. Hope everything's good. So Lev, you didn't talk too much about any risks associated with new tax policy, repatriation of capital. Any risks associated there?
Yeah, it's actually going to mitigate some of the risk in that some of this capital comes back. When it does come back, it's a one-time boost to the U.S. Treasury, right? Because Apple brings back, $200 billion, some massive amount like that, and pays a $40 billion tax to the Treasury. That's sort of an immediate pop for them. And what I was thinking actually, that could delay the debt ceiling because it'll be a little extra cushion for Treasury. But it's a one-time event, and it'll be over. It's done. As far as the overall corporate tax cut, it's a boom for the corporate sector. I mean, you're going to have not only companies moving into the U.S. Because it's so much, the environment is all of a sudden so much better. You're going to have less activity in tax havens offshore. A lot of the capital is going to sort of start showing up here in the U.S. So the corporate tax cut is definitely an extreme positive for growth and for the stock market. The only concern I would have is typically when people introduce tax cuts. If you look at the Bush administration, for example, they introduced several tax cuts. When they did that, it's usually when the economy is slowing, right? When you have a pause in economic growth. And that helps lubricate some of the sort of economic wheels. Here, we're talking about an already strong economy. The economy was really strong, back in 2016. We already had really nice growth and low unemployment. And now you add this tax cut on top of it. It risks potentially overheating the economy quickly. Right, and so you could have high inflation, high bond yields, and a more aggressive Federal Reserve, leading to a quicker slowdown. Right, so this overheating is a little bit of a risk because you're adding fiscal stimulus at the time when it's not needed. Right, and so the Fed will have to compensate for that by removing monetary stimulus quicker, which creates a bit of a risk. So that's kind of my thought on that.
Does the repatriation of capital and new tax policy, will that also help with a pretty significant, I would think, increase in wages? We basically had a wage freeze for the last 15 years overall. How does that impact? How do you see it impacting?
Yeah, I mean, some of the wage increases that you see companies doing is a little bit of a political game where they're basically saying, well, thank you, White House. Here's what we're doing for the United States. But if you combine that with the fact that labor markets were already tight, right? I remember in 2016 people talking about, oh my God, the economy is so slow, and no, it wasn't slow. It was doing really well, and the job market was already really tight. Now it's tightening even more because as more companies move onshore, they're hiring more, looking for more people, and companies are already complaining they just can't hire enough. They can't find people. right?
Right.
I've spoken to 3 companies just in the last few weeks, and they're basically saying that they can't find workers for like factory floors without the only people they can find are people that can't pass the drug test, right? Which is a real problem. So that's the only slack labor that exists, the people that had either have criminal records or have addiction problems. Now, those folks will get hired as well, right, as things tighten. But at some point, you basically literally run out of people to hire. It becomes like Japan, where you want to draw people into the workforce that have retired or people are staying home with kids. You want to draw them back into the workforce because there's just not enough. And if you tighten the immigration spigot, with the basically U.S. workforce isn't growing at all. It's been flat for like 10 years. You got a problem. Right, so wages will rise, and potentially could feed into inflation.
You talked about a number of risks. The potential bond market crash, in essence, being a large one. Is that the biggest one that you see, or what do you see as the biggest?
Yeah, I mean, I think there are 2 immediate risks that I see on the horizon. One is like you said, high inflation and a bond market crash. Yields rising, and for now the stock market's been ignoring higher yields. Oh, who cares? It's the bond market, right? But at some point, you look at bond yields and say, wait a minute, the yield on the stock market isn't dramatically higher than the yield on bonds. On a relative basis, rising yields could really hurt the stock market. So that's one risk. And of course, the Fed raising rates more rapidly is related to that. The other one is trade, and a trade war with China, or even a NAFTA withdrawal, could do serious damage to sentiment and to the stock market, and could also accelerate inflation, right? You think about it, you put a 5%, a 10% tariff on Chinese imports in the United States, and you go to Walmart and everything's 5 to 10% more expensive. Guess what that does to sentiment, inflation, affordability, and so that's a risk. So a trade war, could be significant.
Okay. What about emerging markets? What could derail the market rally there?
Yeah. So one possibility, we've seen the dollar decline, which has been tremendous for emerging markets. A weaker dollar is always helpful for emerging markets. But if rates rise significantly in the U.S., the dollar could start rising again, and that could derail the emerging markets rally. Emerging markets have outperformed the U.S. stock market over the past year by quite a bit, and that could easily reverse.
Mm-hmm. You spoke a little bit about NAFTA. There's a lot in the news, in the journal about NAFTA, obviously, and what are the risks associated with the NAFTA pullout beyond the hit to U.S. agricultural and the automotive sectors?
Yeah, so if you look at some of the most vulnerable communities in the U.S., the rural communities that have been depressed, obviously some of them are reliant on NAFTA. We sell pork and chicken and corn to Mexico, and getting that, if that takes a hit, it's a problem. We sell gasoline to them, natural gas. So Texas could get hurt, but those are manageable risks. What I'm more concerned about is a pullout of NAFTA will put Mexico into an economic depression, You know, 80% of their exports are to the United States, right? And so if you create a depression, economic depression in Mexico, and many people in this country say, yeah, good for, you know, do it. But people don't understand what the impact it has. There are two things that will happen immediately. One, people are concerned about illegal immigration. With regard to Mexico, migration has been the other way in recent years, meaning that there are more people going from the U.S. to Mexico than from Mexico to the U.S., right? Now, you create a depression in Mexico, and the flood of illegal migration into the U.S. will just accelerate. So it actually will worsen the problem that you're trying to solve here. And that you're talking about, you know, humanitarian issues, right? You're talking about thousands of people who lose their jobs and are trying to survive running across the border. And no wall is going to stop them, trust me. Right. So that's one thing. The other thing, and again, the media doesn't talk about it because they don't understand it, is one of the important economic, underground economic trends in Mexico is the dependence on opium exports, so opium-related products, heroin, right? So we fight a war in Afghanistan, trying to keep Afghanistan from moving all that heroin around, right? But the heroin from Afghanistan is going to Europe and to Asia. Heroin coming into this country tends to come from Mexico, right? It's already a major issue. Imagine if the peso tanks and the economy gets depressed. The price of heroin will come down to the point where a school kid can buy it with lunch money, right? And the flood of heroin into the U.S. will accelerate, right? So those two things, I think, are I would call them sort of national security risks that nobody talks about.
What's going on, Lev, with trucking and freight? We've seen in the last year that prices have just gone through the roof to move product, especially via truck. When are we going to see this impact prices, and what's that going to mean?
Yeah, so far it's been hitting margins, right?
Yeah.
Because people basically been able to, but it's starting. I think Amazon jacked up the price for their Amazon Prime accounts. I don't know if you saw that.
$2 an account, $3 a month, right?
Right, and the reason is that they provide you free shipping as part of that account. But now that shipping is getting more expensive. It will continue to get more expensive. Now, combine that with rising gasoline prices, right? Because as crude oil prices, been lifted, gasoline prices are on the rise as well. And so, diesel and gasoline, and so your shipping costs have capacity constraints, so the price is going up because of that. And now you're going to have fuel impact. So the combination of those two things will feed into inflationary pressures, and that's why I'm saying, this is the year when inflation should start popping up. Right,
and you also have regulation on the drivers themselves now that are being enforced.
Yep. Yeah, and without good infrastructure improvements. If you ever talk to any truckers, they will tell you that one of the constraining factors for them is, terrible highways, right, where it takes them longer to move. There's more wear on the truck. There's more wear on the driver, and it's an issue.
Yeah. All right. Well, Lev, thanks again. It looks like we're right at our we're right at our hour, a little over as always. I want to thank everybody who signed in for the hour, as well as our presenter, Lev Borodovsky. Should anyone have any further questions or feedback, feel free to email them to us at webinars@starmountaincapital.com. We will be emailing everybody who registered and attended the slides from today's webinar, along with a replay to the webinar, where we will put it on YouTube. We also now have a couple of podcast channels where we make them available. So we try to make them readily available for everybody. Lev, thanks again. This was great.
Thanks very much, guys. Take care.
All right, guys. Everybody, have a good day.